Understanding Investments a Few Minutes at a Time by Daniel Dower from Chapter 9, Fundamental Analysis, Issue number 43, Market-Based Assets. Much of the value investor canon focuses on buying companies at a low price-to-book value. It seems intuitive that if we can buy a company for some fraction of the cost of its assets, we may be getting a good deal. Unfortunately, as wonderful as modern accounting can be, it has a few gaping holes. Assets are recorded at their cost. Perhaps even more importantly, costs such as marketing or the development of beneficial relationships with suppliers, distributors, customers, are almost always expensed. Our accounting has no protocol for acknowledging the value of an internally built brand, like Coke or its valuable distribution network. Indeed, there's a growing recognition that a significant proportion of the market value of firms today, 70% or so, lies in intangible off-balance sheet assets rather than tangible book assets. In the early 20th century, when texts on value investing gained popularity, the U.S. economy was still largely based on manufacturing and agriculture, industries where cost of land, factories, and other assets played a much larger role in the company's value. In our modern global consumer-based world, enormous value is stored in various market-based assets, including brand equity. The value of McDonald's, Coke, or BMW transcends the cost of production. This has a dramatic impact on how I screen for and analyze companies. Give it some careful thought and develop a method that works for you. I screen by return on assets as one indicator for something worth a longer look. If assets on the books are understated due to market-based assets, it follows that ROA and ROE will be abnormally high. This table lists a quick sampling of some of the world's most valuable brands based on Forbes' 2013 listing. Ford, Caterpillar, and Dow all have lower ROA and P/B ratios. These companies have some market-based assets, but they rely more heavily on inventory, manufacturing, and facilities, and assets that are carried on the balance sheet. If we want to identify companies with high brand value, it may be better to search for high price to book as opposed to low.